In this video, I am going to explain fund flow statement. The fund flow statement contains three important steps. The first one is schedule of changes in working capital. First, we need to find the schedule of changes in working capital. And second one, fund from operation. It is an internal sources of an organization. And third one, fund flow statement. So fund flow statement contains two things: sources of fund and applications of fund. So let me explain the basic concept of fund. In a broader sense, funds means a total resource of an organization is called fund. But in a narrow sense, cash or equivalent to cash is called fund. For the fund flow statement, fund means working capital. So organization need to have sufficient working capital to meet their day-to-day operation is called fund. So generally in an organization, they need to have different types of or different terms of capital. The first one is long-term capital for a long-run basis. The second one is medium-term fund, and the third one is a short-term fund. First thing, you need to find out the working capital. Fund means working capital. So what is the meaning of working capital? Working capital means the total amount invested in current asset is called working capital. This is called as gross working capital. So working capital can be classified into two categories. One is gross working capital, another one is net working capital. See, gross working capital means total amount invested in current assets is called gross working capital. Net working capital means current asset minus current liability. That is, the excess of current asset over current liability is equal to net working capital. So generally working capital means the amount invested in current asset is called working capital. It can be two types, gross and net. Gross means total amount invested in current asset. Net means total current asset minus current liability. So this is the basic concept of working capital. See, the first thing you need to find out the schedule of changes in working capital. So you need to have two data. Two years information is required in order to find the changes, whether it has increased or decreased. That is the first step in fund flow statement. The first one is schedule of changes in working capital, and second one, fund from operation. Fund from operation means organization, they need to have a sufficient fund. The fund can be internally raised by the organization or they can raise fund from the outside. Internal source is called fund from operation. That is, operation means the activities of the organization. The major activity of the organization is called operation. So fund from operation means income from the operation or the profit or gain from the operation is called fund from operation. And the last step is preparation of fund flow statement. So this statement contains two things. One is sources of fund and application of fund. Otherwise we can say as inflow of fund and outflow of fund. How we are raising the fund, what are the various sources are available to raise the fund is called inflow of fund or sources of fund. Application means in what way we are spending the money. So what are the major applications that the outflow of fund is called application of fund. So this is the final step in fund flow statement. Let us see the each and every format separately. Schedule of changes in working capital. Before we prepare the fund flow statement, the first step is we need to find out the changes in working capital. For that we need to have 2 years information, that is current year and previous year, in order to find whether the working capital is increased or decreased. So this is the format. Let me explain the format first, then we can go for the problem. So this is the procedure to prepare the schedule of changes in working capital. This particular column, in this column you need to record all the current assets and current liabilities. 2 years information will be there. Here you need to write 2 years information in order to find the difference, whether it is increased or decreased. And the last one is changes in working capital. In changes in working capital, if it is increased, you need to write in this column. If it is decreased, you need to write in this column. So let me explain what are the different current assets and current liabilities. Look at this format. Current asset. So current asset means any asset which can be easily converted into cash immediately is called current asset. Cash in hand is a current asset. Cash at bank, that is bank balance, current asset. Short term investment. So investment can be two types, long term investment and short term investment. If it is short-term investment means it is a current asset. If it is long-term means it will be non-current asset. Advances recoverable, debtors, bills receivable, stock. Stock can be in different forms. That is in the form of raw material, or in the form of work in progress, or in the form of finished goods, or in the form of spares. So these are the different forms of stock. But anyway, it is a current asset. Accrued income. Accrued income means outstanding income. Any income not yet received. You have done the work, you have rendered the service, but you didn't receive any income for that. That income is belong to current year, but still you didn't receive. It's called accrued or outstanding income. So any outstanding income is an asset. That is current asset. Prepaid expense. So any expenses which is not belong to current year but which is belong to next year, but you have paid the particular expense in this current year means which is called as a prepaid expense. So prepaid expense also current asset. And reserve for discount on creditors. When you make any provision for discount on creditor, it is also current asset. Next one, current liabilities. The liability which we need to repay within 1 year or within a short period is called current liability. So these are the different forms of current liability. Creditors. Okay, when you acquire raw material on credit basis from a supplier, they are called as creditor. We need to pay amount. We are due to supplier. They are called as creditor. It is a current liability. Bills payable. Okay, we have acquired the raw material from supplier without paying money and we accepted the bill. So we are supposed to pay some amount on the due date. So till such time it is a liability. Bills payable is a liability. Then income received in advance. So any income received in advance is a liability. This income is not belong to current year. This income is belong to next year, but we have received in advance. So it is a liability. Then outstanding expense. Any expenses not yet paid, but the particular expenses belong to current year, but still we didn't pay that amount is called outstanding. So any outstanding expense is a current liability. Then bank overdraft. Overdraft means withdrawing excess amount than the actual bank balance is called overdraft. It is also current liability. Cash credit. We have borrowed money from the bank. It's a cash credit. It is also liability, current liability. Short term loan. We have borrowed money from the bank. It's a liability. Tax payable, it is a current liability. Dividend payable, it's a current liability. Any provision for doubtful debts. If you make any provision for doubtful debts or provision for discount on debtors, so these are also current liability. Okay, see, for tax payable and dividend payable, these two items can be considered as a current liability or non-current liability according to the problem. If there is any adjustment regarding these two things means, then you can consider these two items as a non-current liability. In such case, you need not write these two items in this schedule. Okay, instead of this will be recorded in some other two places that I will explain you later. Okay, these are the current assets and current liabilities. Okay, so after recording this, here we have two columns. First column for previous year transactions and this column for current year transaction. And the next one is changes in working capital. Here you need to record any changes in the current asset and current liability. So here you need to follow a simple logic. See, when current asset increase, you need to compare the two value, that is current year value with the previous year value. If there is any changes, that will be noted down here. When you record the changes in this column, you need to follow a simple logic. When current asset increase, working capital also increase. That amount can be entered here. When the current asset decrease, that will be recorded here. Okay, so when current asset increase, working capital also increase. When current asset decrease, working capital also decrease. Okay, you need to follow this logic. When current asset increase, working capital also increase. When current asset decrease, you need to record that amount under decrease column. Why? Because working capital also decrease. Okay, so the same direction you can follow. When current asset increase, working capital also increase. When current asset decrease, working capital also decrease. For the current liability, when current liability increase, working capital decrease. When current liability decrease, working capital will increase. Just opposite. Look at the previous one. Here, current asset increase, working capital also increase. But here, current liability increase, working capital decrease. When the liability increase, automatically it will lead to decrease the working capital. Why? Because our burden is increased. So that will lead to decrease our working capital. Just opposite direction. When current liability decrease, when our burden decrease, it will lead to increase our working capital. Okay, just opposite direction. When current liability increase, working capital decrease. When current liability decrease, working capital will increase. So you need to follow this rule. Just compare the two values. If the current liability is increased, that will be recorded in decrease column. When the current liability is decreased, just enter the difference amount in increase column. Okay, just opposite. According to this logic. So this is the way to prepare the schedule of changes in working capital. And finally, you will get the balancing figure. In the balancing figure, the amount will be either increase in working capital or decrease in working capital. Let me explain this format with the help of one problem. The following are the summarized balance sheet of Prem Limited as at 31st December 2013 and 14. So two balance sheet is given for two different years, 2013 and 2014, asset side and liability side. So look at the various assets and look at the various liabilities. Fixed asset, investment, current asset. You need to concentrate only current asset. So stock, debtors, bills receivable, prepaid expense, cash, advances. So these are the current assets. Look at the liability side. Equity shares, preference shares, general reserve, profit and loss account. These are all non-current liability. Look at the current liability. Creditors are current liability, bank OD, bills payable, taxation provision, proposed dividends. So these are the different components of current liability. Prepare a statement showing the changes in working capital. So with this information, they ask you to prepare the schedule of changes in working capital. This is the format to prepare the schedule of changes in working capital. In the particular column, list out all current assets and current liability. In the two columns, you need to record current asset and current liability for 2013 and 14. The last one is changes in working capital. When current asset increase, that will be recorded in increase column. When current asset decrease, that will be recorded in decrease column. But for current liability, when current liability increase, that will be recorded in decrease column. When current liabilities decrease, that will be recorded in increase column. This is the procedure to prepare the schedule of changes in working capital. Now list out all current assets and current liabilities. What are the current assets are there? Stock, debtors, bills receivable, prepaid expense, cash and advances. Stock 45,000 and 65,000. Advances 13,000, 45,000. All the current assets for 2013 and 14 are recorded here. Okay, in the same way, list out all current liabilities. Creditors 20,000, 15,000. Dividend 20,000, 25,000. First, you need to record all current assets and current liabilities which is given in the problem for 2 years, 2013 and 2014. Now you need to find out the changes in working capital with the help of that simple logic. Look at the two values. Stock. First year 45,000, next year 65,000. What is the difference? Increased from 45 to 65. What is the difference? 20,000. No. So when current asset increase, working capital also increase. Next one, from 20,000 to 40,000. 20,000 increased. So working capital also increased. 20,000. Next one, bills receivable from 6,000 to 3,000. So reduced, so decreased. So when current asset decrease, working capital also decrease. How much? What is the difference? 3,000 decreased. Prepaid expense 6,000, 20,000 increased. What is the difference? 14,000. No. So increase column. Increase in working capital. Then cash 25,000, 15,000 decreased from 25 to 15. What is the difference? 10,000. So decrease column. Then advances from 13 to 45 increased. So working capital also increased. 32,000. Okay, now look at the current liabilities. Just opposite. Okay, current liability. First one, creditors. 20,000, 15,000. So creditor is reduced from 20,000 to 15,000. What is the difference? 5,000 decreased, no. So when current liability decrease, working capital will increase. 5,000 increase column. Bank overdraft. First year 5,000, next year 0. So from 5,000 to nil, which means 0. So reduced from 5,000 to nil value, no. So when current liability decrease, working capital increase. Next one, bills payable. From nil to 3,000 increased. From 0 to 3,000 increased, no. So when current liability increase, working capital decrease. Then tax provision from 10,000 to 15,000 increased 5,000. So working capital decrease. Then proposed dividend increase from 20,000 to 25,000. So when current liability increase, working capital decrease. First you need to find the total for first two columns. This is total current asset total A. Okay, next one, total current liability total called B. Okay, just find the total for this column and find the total for this column separately. 1,15,000, 1,88,000. Here 55,000, 58,000. Net working capital, that is A minus B. Current asset minus current liability is equal to net working capital. Just find the difference. 1,15,000 minus 55,000. What is the difference? 60,000. For the next year, 1,88,000 minus 58,000. What is the difference? 1,30,000. Okay, after finding the net working capital, now find the balancing figure for two columns. Okay, in the same way, you need to get the total for changes in working capital column also. Find the total for this column. 20 plus 20 plus 14 plus 32 plus 5 plus 5. What is the total? 96,000. Okay, same thing you can write here also. 96,000. Okay, so increase column is greater than the decrease column. Decrease column, here we have only 3 plus 10, 13, 13 plus 3, 16, 16 plus 10, 26. So we have only 26,000 in the decrease column. But in increase column, 96. So what is the difference here? 70,000. Okay, this is increase in working capital. So how you got this amount? Excess of increase in working capital than decrease in working capital. So increase in working capital is 96,000, but decrease in working capital is only 26,000. The difference is 70,000. So this is called as increase in working capital. Increase in working capital. Okay, 70,000. Now get the total for these two column also here. For the next year, 1,30,000. First year we have only 60,000. Put 1,30,000. Balancing figure is, what is the balancing figure? You'll get the same value, 70,000. That is increase in working capital. First year the working capital is only 60,000, but the next year is 1,30,000. What is the difference? Increased or decreased? Increased. How much increased? 70,000 increased. So this is the way to prepare the schedule of changes in working capital.